Deepak, how much of an investor's portfolio do you think a domestic investor, an Indian investor's portfolio should be invested in the international markets? You've made the point about why it's important to look at international funds, but how much of a portfolio, and of course, I know there's no right answer, it will depend from investor to investor and depending on what your diversification is. But as a simple thumb rule, do you advocate that there is an X amount of percentage that you should diversify into international funds?
Yes, so we have at the Capitalmind Wealth PMS that we actually have an allocation to international funds and a Nasdaq 100 ETF, if you may, and that has gone up to 33% to 35% of portfolios. We've got another portfolio where we've got about 10% in international stocks. So the idea here is it can vary over time. It can vary over investor to investor as well. Because some investors may actually want it, some investors may not. But I feel there is a tremendous amount of, you have to do a little bit of research for what applies to you. But even a 50-50 allocation to India versus US has done very well in the past. You also get, for instance, for free, the rupee depreciation that happens when you invest in an instrument abroad, because roughly the rupee depreciates about 3.5% per year. This is what it's done since 2000. 3.5% per year doesn't happen every year. It's bunched up, right? So you get 4 years of nothing and then 1 year of 15%. So if you're there for the longer term, you're likely to make one of these bumps in rupee depreciation, and that will add to the return. So if the US market goes up 10% and you get 3% rupee depreciation, that's 13% for you that you've got in a certain time frame. So apart from that, we've back tested going back all the way to say 2002 or even 2000. If we were to have invested in the US indexes and correspondingly converted to rupee at the appropriate exchange rate of those times, and even did an SIP, a combination of 1/3 US, 2/3 India, or even 50% US, 50% India, would have beaten most Indian mutual funds, would have beaten the index itself in India, and perhaps a lot of active managers as well. So this is a very interesting phenomenon, and most of this has started to come after 2000, maybe 2010, 2011 is when the Nasdaq really started outperforming. The US markets really started moving up. So you got a lot of the outperformance in the last decade, if you may. But what has happened is this gives you that asset allocation feel of everything's not related to India only. And we also get the fact that you have enough of an allocation. That's not a 1%, 2% kind of allocation where you can just feel good. Even if it doubles, it's only another 2% of your portfolio. But you should have a significant, 10% to 20, 25%, depending on who you are, that applies to your portfolio asset allocation as a whole. And I say this as a better alternative to trying to do things like investing in gold and doing sector or thematic specific funds, because this is a much better way to diversify than those, even if you look at the back test in the past.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.